All right, so the markets are started this post MLK holiday week with a couple really down days. So I'm going to break down the trend of the market, right? Or which direction we're headed. Are we still just in a pullback mode? Has the trend changes to where now the pullbacks are to the upside and not the downside? So we're going to break that down to see what's what and what the indicators are saying and what we should expect to see. I mean, have we washed out now? Is this was a lot of selling? We're going to take a look at volatility and volume levels and trading ranges to see if we've had such extremes that we're essentially washed out here, especially getting cluster or really close to clusters on some of these indicators. So I'm going to show you all of that, talk about what I'm looking at going forward, talk about what's driving a lot of this weakness right now, and what that means and where there might be some pockets of relative strength going forward. And then our trade ideas in the stock, really popular big U.S. Materials company that kind of broke down itself today. And we'll talk about how to trade it and why and what strategy to use. So let's go ahead and get started. Today is Wednesday, January the 19th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see, obviously, we have dark pink shading and a red line now on the S&P. It's the first time since back here during this post-Thanksgiving decline. And then, of course, a little bit longer period over September and October of earlier this year. We are 3.5% below the 30-day moving average, which is what you see down here. The red dot means that we are in the less than the 10th percentile. This is actually the lowest level that we've been in the last 3 years. If you go out to, let's go back to like say April the 7th of 2020, since the COVID low, because that kind of throws off the scale, right? We were 20% below the 30-day moving average there. So when you look at between now and then, we are just inside the 10th. So we were further below, not very much, but about 5% below over here. We hit 4.78. We hit 3.5 over there as well. So that kind of gives you an idea of where we've been during prior intermediate declines. Of course, if you go all the way back to some of the past market sentiment declines. So let me just kind of throw on. I'm going to throw on this line here. We're going to go 3.44. You take a look at, you can kind of see all these intermediate declines kind of look all the same, right, in terms of where we've been, and some of these other intermediate declines as well, about 3.5%. Obviously, COVID sticks out. The 2018 period sticks out. Early 2018 sticks out to a degree. And then you have to go all the way back to 15 and 16. Those areas stick out. You can see all these other intermediate declines. And then 2011 sticks out. And again, you've kind of seen here. I tweeted out this earlier today because Brandon shared this chart about the NASDAQ composite, about how much we're below that 25% mark in terms of the percentage of stocks below the 200-day moving average. You can see 2011 stands out, 2016, 2018, and the COVID, right? So if you look at this chart, there's COVID, 29% drop. This on the NASDAQ composite, 22% drop in 2018, 17% drop in 2016, 18.5% drop in 2011. We are at 9% now. Look, this is early in the morning, so it's probably about 10% now. But it kind of gives you an idea that we're like these areas. If we're going to have a similar move to what we saw there, which is not a bad thing, because look at the green tags that came up. Now some of the green tags going into are pretty strong. We had a 95% rally there in the 2010, followed by a 37% rally, and then we had that 18% drop. We had an 82% rally, followed by that. We had an 86% rally, followed by that. Then we had this 53% rally, followed by that, and then 133% rally, followed by this night. So it's not a bad thing, right? You get these red tags, you get really big numbers and green tags that come after that, generally speaking. So it's not necessarily a bad thing to come down, but you can see how we're not really down there. Like, this is typical for the type of move we've been seeing and, some of these other intermediate declines. But if this ends up being something more like, 2020 and 2018 and 2016 and 2011, then you can see that we're probably not done yet on this. Let's take a look at some of the other indexes. Let's look at the Dow Jones. Remember, that's been the more bullish one. it's been breaking down a little bit more. You can see its short-term sentiment is very bearish now, as we are 2.5% below. That's the magic number, right? Light pink shading and a red line. You see we're breaking that 62% retracement of this intermediate run that we've been on. SPX was doing that as well. There's the intermediate run that we've been on here. From this low point all the way up to this new high. We are actually in or really, really close to bearish territory, and also very bearish short-term sentiment. And you can see we are breaking the 78% retracement of that rally, which means now that the bullish moves will be pullbacks, right? So we look for resistance in the 62% area, and as if and when we do rally, a very good chance that we're actually rallying the very short term off of these lows. You can see the Russell. Russell got an oversold cluster with the very bearish short-term sentiment, and the intermediate line is actually well in the bearish territory. It's actually in the lower reversal zone now. So really bearish pattern. As you can see, we're through these lows. You also see here that, and now I can take this off since we've made a new leg lower. But you also see here. So here is, let me go out to 2 years on the Russell. The black line is that intermediate rally we came off of the Halloween low point, where we peaked here at in March, and then we went on this tremendous sideways range. That's what the black line. You can see after hitting that peak, we tested at 23%, we tested it again, we tested it again, we tested it again, we tested it again, and then we rallied, and then we bust through it yesterday. Well, now if you look at that orange line is the COVID low, all the way up to this fake out high point that I referred to before when we had that fake out up there. So that rallied here, and now you can see that we are pushing below that 23% line of the orange line to the downside. So like the Russell 2000 is on this long-term decline, like pullback, right? Very, very long-term pullback, and of course you can see where some of these Fibonacci lines line up. 38% is at 1888. You can see where that 62% level is, right about where the 50 is. 50 is sitting right at those pre-COVID highs. So you kind of get an idea of how far down that Russell 2000 can go. The NASDAQ 100, let's take a look at it. Obviously bearish posture. Not quite the cluster yet, but pretty darn close. The intermediate line is just barely above 20. It's also the furthest below. It actually got a little bit more below in March. The 30-day moving average got to 7.5%. We're 6% down right now, but it's further below than where we were back here in September and October. We are obviously dark pink shading and a red line. We are breaking that 62% retracement of that intermediate rally. I don't really count this one. It was too short. The only reason why we got back above the 23% is because it wasn't very long lasting there. And then you can see, how close we are to breaking the 78%, which again suggests that we are now on the impulse moves are to the downside, and the pullbacks are now to the upside instead of typically you look at the drops as pullbacks when you're moving up to higher highs. So that's what we're seeing right now on the market forecast indicators. Let's take a look at the long-term charts. Obviously, remember there's three things we look for here: a negative differential, a red arrow with no upper shadow on the chart, and then falling PPO. Got that on the S&P. We are bearish on the S&P. The Russell 2000 is actually in a death cross, right? The 10-week is crossed below the 40-week. That's why you see that pink shading there starting up. That's also why you see a negative PPO. And we have negative differential, so we have been below the 50, and we're really breaking down now. Now that you can see that the Hakinyashi close is below that black 23% level that we've had. If you look at the NASDAQ 100, we've been on the red arrow for a while. Definitely getting some bearish candles here, and you can see the PPO dropping. And then of course your Dow Jones, which has been the most bullish, finally giving it up this week. Red arrow, falling PPO, and negative differential there, which means that we have a red box, a bearish candle with no upper shadow. Obviously is relatively bearish. So bearish charts across the board. Not surprising, right? You can see we have three red arrows across the board: light pink shading, pink shading, pink shading, pink shading. Multiple days in a row of pink shading, which means we're probably going to have pink shading, sometimes interrupted by, the clear. You can see sometimes interrupted a little bit by green before you get more pink shading. But 3 red arrows all across the board, all of them, well below the moving averages, all over the place here. When you look at the 2-line version of those MACDs, you can see we are well below the 50-day moving average, on our way to filling in that gap between the 50 and the 200-day. When you look at the weekly, we've still got a couple days left in the week, so take that for what it's worth, but we are below the 17-week. So let's see how we finish the week. Remember, getting below the 17-week is we're in bearish divergence mode, which we haven't been for a while. Like, getting below it's one thing, but staying below it's another. We've been below it a couple of times. We came roaring back pretty much both times. So we'll see if that ends up being the case again. That's obviously has not been the case on the Russell. So there's what the weekly chart looks like there. Obviously, this would be a very bearish close, because look at all these weekly lows that we have that we would be breaking if this were to hold. So very, very bearish move, and very big gap between the 50 and the 200 week moving averages that we can fill in. Of course, here's what the daily chart looks like. We are way below these. I mean, we are in bearish mode on the Russell 2000. We've been hedging the Russell for quite a while in our class portfolio with the idea that this kind of a move, we've had potential for this kind of move for a long time, and because we went so fast to the upside, then we went so sideways for a long time, it really built up a tremendous gap in volume here, a big shelf in volume with nothing in between, down to the downside. Remember, down to that 200-week moving average. So we've been hedging it for this very reason, and you can see after that fake out trade there, or fake out move, now it's playing out. If you look at the NASDAQ 100, you can see it has now filled in the gap between the 50 and the 200. That 200 is very much in play now, so that's something we need to pay close attention to. There's the moving, very much a bearish divergence going on. The MACD is way below. So I mean, we could very well get a pretty decently bullish move tomorrow back to the 8-day moving average, like we've seen every time we get below that. So, again, there's a certain distance you get away from the 8 before you return to these really short-term means. So I think we're pretty decently away, especially hitting the 200. Tomorrow could be one of those days where, when you're in these bearish moves, you tend to get some pretty decent green bars, 1% plus. Tomorrow might be one of those days we get a 1% move to the upside, and it would not necessarily mean that this selling is over with, not in the least bit. Even if you might hear on TV a lot of chatter about maybe we found the bottom, right? Let's go back to this chart. We looked at the Qs, we looked at IW. I wanted to look at the Qs on the weekly chart. So here's what the weekly Qs looks like. Remember, the S&P is just breaking the 17. The Qs already have. So the Qs already have broken that, and now we're holding that breakout. And we are now below the 30-day, which we hadn't been this entire time. We've never broken the 30. So we are in bearish divergence mode there too. And you can see we're kind of just getting going on the Qs. Remember, the IWM, the stochastics is bearish. The MACD is pretty negative and diverging to the downside. We are breaking through 23% retracement on that market sim. We still haven't we haven't even gotten to the 23% retracement yet off the COVID low for the NASDAQ. So again, you can see why the IWM has been a lot more bearish than the Qs have been, and why we're more hedged against that than anything else. Let's take a look at some of these other oscillators on the S&P. Start off with the DMI. You can see we're well above 30. We are in breakout mode here, above 35. We finally got below 20 on the negative, so we are in the look how low the ADX is too. We are in breakout mode, and this takes a while. IWM, you can see we've already had a pretty decent breakout move when we got above 35, got below 20. Same, we're headed that direction again for another leg higher with the ADX just barely getting above 20 here. And then, of course, your Qs, your Qs above 35, below 20, ADX rising above 20. We're breaking out, right? We are breaking out here to the upside, and this is, you expect this kind of move, and however long it ends up taking. I believe it will be, like I said, Previously, the Russell 2000's market sentiment line is already below 40, so this is a market sentiment decline according to the Russell. The S&P, the market sentiment line's got a long ways to go if it's going to end up being a market sentiment decline. The Nasdaq is just, it's already almost outside of bullish territory, and then your Dow Jones Industrial Average is kind of right there too. So there's a good chance that, unlike these other intermediate declines, this time the orange line gets below 40 and gets in the bearish territory. Let's take a look at the RSI and the CCI. You can see breaking 40, breaking that minus 150 down there at the bottom. The NASDAQ, same thing, breaking 40. Not quite as bearish on the CCI. The Russell breaking well below 40. Actually, we're below 30 again. Well below 150, so really bearish on the Russell 2000. And then, let's see, did I do SPX? Oh, the Dow. The Dow Jones, you can see breaking 40. Well, broke below 200 yesterday. So this chart's telling us, confirming the bearishness. We are not through the cloud yet. So again, we haven't really gotten started yet on SPY. We are just getting to -2 and 65. So this is the first day that we've actually started a bearish trend on SPY. IWM, it's also, yesterday we were at -2 and 69. So yesterday was the first day, and today now we're that quickly. We're almost to 5 and 80. So we are bearish mode there. The Qs, you can see we are at where are we at? -3 there, and then up to 74. So we are definitely in below the cloud there. And then your diamonds, just below the cloud on that as well. And we haven't even started. We haven't even gotten to 50 and -1 yet. So again, we are just kind of kicking the tires here. We haven't really blown out on these charts in the least bit. Here's your Bollinger Bands for the spiders. We are definitely in the lower quartile. In fact, we got below the lower Bollinger Band today, -0.5. So a little bit of a breakdown on the lower band. We've 2 days in a row we've been below the lower band on the IWM, so we're definitely pushing down there. The Qs, you can see we're in the lower quartile. The diamonds, we broke below the lower band. We got the point of control sitting there. Then obviously there's a lot of bearish charts that are all really confirming each other right now. Let's see here. Let's take a look here at this 4-week, the early chart. Not quite a new 4-week low on SPY. So the 4-week low, so we still haven't got the bearish Arun breakout. I guess we did, because that day is going to move off. This will be that. So you did get the bearish breakout there, and you remember you typically don't set a bottom at least until the green line hits 0. That's when you typically hit that bottom, like we did on that one there. Coming after that spike to minus for the negative indicator up to 0. Obviously your IWM's up there for the second consecutive day. Your Qs are up there again with a really bearish, but the 4-week high is way back towards the left of the chart, and then diamonds. Just getting that 4-week breakout today too, and still the high is still on the other side. So you can get an idea that we're just kind of starting, and the high is just here, so there's still room to the downside on all these indicators. Let's see here, was IWM? Yeah, IWM a few days ago, and I think SPY too, didn't it? Yeah, SPY. We got this runaway gap yesterday. We tried to fill it in today, but we only got up to the high of yesterday's intraday move. We didn't fill in any of the gap from this morning. And now, obviously, a lower high and a lower low, closing well below last week's low. Really bearish candle, and like I said, a really good potential for that to be a runaway gap when you look at the gap there was more than 2 standard deviations to the downside. We didn't quite finish with a -2% or more, so that's the only thing that's really lacking here. And you see that showing up as well in the volatility index. The VIX isn't really too high. It's at 24. It's here at 92.5%. But I mean, I would expect that we'd be well above 100% on the VIX, which means the VIX 3M is still pretty high too. The market's still just as concerned about 3-month volatility as they are about the next 30 days, which means that the market still is expecting a longer decline, not just a quick buy the dip, bounce this, and then we can rip higher again. It's kind of expecting volatility to last for a little bit of time. So that's why you see, as bearish as we are, we're not really breaking out. And so what you're also seeing with that is we didn't get a lot of volume here. We did pick up at the end of the day, but it ended up being about the same as yesterday, about 109 million. The trading range ended up being above average. When I did my class, it was actually below average. I ended up being a little bit above the average at 8 points. So when you look at those two numbers here, you know, that 100 million is right in this area. So, I mean, you can see we're not really ramping up. See, all those times that the VIX jumps up, it's accompanied with rising volume. Look at this. These VIX spikes here on a relative basis down in the lower chart. These VIX spikes are associated with jumps in volume here and early in May, and then beginning of the year, and then October. So when you look at, you know, those same time frames on the volume, go out 2 years here, you can see the jumps in volume. These are also associated with jumps in volatility here and earlier this year, and then end of last year. That's when our volume jumped. You see the spikes there. So you notice we're not really low either, but we're also not really jumping hard yet. And we're definitely not to the 2% mark, which is typically when these intermediate declines end. Let me kind of give you an idea of where we get to on these other kind of market sentiment type declines. So there, COVID was obviously a much different story. The ATR got up to over 6% to the price. So we got over 15 points, 17 points there. On the 2018, we got up to 4%. In 2016, we got up to almost 4%. And then in 2011, I have to go out 15 years. 2011, right over here, we got up to about 5%. So there's 16 at about 4%. And like I said, 2018. So, you know, if we are actually planning on getting to, and this is actually on a weekly chart, sorry. Let me do the daily. If we are actually planning on getting, there's 2018, so right above 2%. Sorry, that's right underneath 3. There's your 2016 up to that 2% level, and then there's your 2011 up to almost 3, and then 2010 almost to 3. So we are at 1.5. We're not even to 2, much less to 3%, which is probably going to be more typical, especially as the VIX gets up. So again, I would say probably early stages and more of a market sentiment decline, more in line, forget the COVID because that's very anomalous, but more in line with what we saw at the end of 2018, especially because we had all those, you know, restrictive policies with the Fed. More in line with what we saw here in 15-16 when those restrictive policies started, and then more in line with 2011 when we had the credit downgrade. So those are all typical market sentiment declines. You know, more so than what we saw with all these other pullbacks that are more in line with just the intermediate line dropping below 40 on the market forecast indicator. And like I said, there's the VIX. Again, we're not really done with an intermediate decline. We're not even starting the intermediate decline until we're above 100%. So we're not even there. So the VIX has still got some room to go, and by the market sentiment declines, is again, if I were to kind of show you those same time frames, market sentiment declines. There's COVID. There's end of 2000. Here's the end of 2018. We typically get up to about 115%, well above 105. There is the end of 15 and 16, again, right up to 115% when we first started, and then 2011, well above 115%. So these kind of moves, we expect volatility to get up in this range on a relative basis relative to that VIX 3M, and we are still way down here, right? Way down here. So just to summarize, we're finally getting a lot of these bearish confirmation signals, and from what it looks like, we're kind of just starting on this trend. That doesn't mean that we're going to be down for 3 months every day. There's going to be a lot of really strong 1+% moves to the upside as we return back to the short-term mean, that 8-day exponential moving average, and maybe even up to the 17-day. But unless we really break through and change the trend, expect those to be short-term rallies until we get new bearish legs lower to the downside. So that's kind of what I'm expecting. I expect that will probably last another couple of months here. A lot of these charts are suggesting that we're just getting started on this. So the choppiness, the up and down moves, but on a net basis down, we could be going here for a while. It might be one of those situations where we go down for about a month or so, and then we just stay down for the next few months after that, next 1 or 2 months after that. And it appears that we're starting that now. So what do you think? Do you agree with that? Do you disagree? Let me know in the comments section below, especially if you disagree. What charts or indicators are you looking at that suggest why you're either a lot more bullish than I am or a lot more bearish than I am? Post those in the comment section down below. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us 2 things. You liked our video today. You want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. And we really appreciate that because it helps us get our video out to more viewers. The more engagements it has. That's why we always ask for it. Also comment down there. What stood out to you in today's video? What questions or comments you have about anything I brought up or any charts I showed? Post those in the comments section. Join our website on marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right. Click on the Market Outlook Live icon. That takes you to this page. You can see our Market Outlook Live videos. I do, in conjunction with these recorded videos, I do a live version at 3:30 Eastern Time. I basically, and these are short videos, I review all the trades that we've done in my old Market Outlook videos to see whether we should stay in them or get out of them. We also already put on today's trade at the end of the video. You'll see we already put that on today before the market closed. We did that here. You can see all the archives as well. You can also get to it by clicking on Market Outlook Live Trade Review there. If you come down, you can see our upcoming classes. Click on View More. It takes you to our calendar with all of our upcoming classes, all of our recordings. You can get to it by clicking on Trading Rooms there as well. Come down to the bottom, click that heart. It opens up this tab. Hit that like button. Also click on this thumbs up icon. Takes you to this page. Hit that like button as well right there. Again, the more you do that, the more engagements we get, the more people actually see our stuff. That's the way their algorithms work, right? That's why we always ask. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here. All right, now let's take a look at what's driving a lot of this price action. Look at the big drop in U.S. equities, way more than anywhere. In fact, emerging markets are actually higher today by the end of the day, along with commodity prices. Gold was up big with the dollar being down, so the euro rallied again today. Remember, the euro actually had fallen, had dropped back down to some moving averages, hit those, and bounced back up today. So the dollar is down. If I take a look at the currencies, let's take a look at all the major currencies here. Excuse me, this one over here. All the major currencies here. If I just look at today alone, you can see where the dollar was. So everything rallied today against the dollar, including the Australian dollar. And then, you know, most of these others, if you look at the franc and the yen, they were actually down. Those are your typical safe haven currencies. They were down. The euro was up against the dollar. That is actually the safe haven currency right now. Your Canadian and your New Zealand dollar was underperforming. Your pound pretty much matching up. So kind of an interesting day in the currency market. Really wasn't a big, broad sell-off there that you would have expected when you saw. Like I said, emerging markets were actually up today, so it was not a big, broad sell-off from that perspective. Let's take a look at this asset class chart here. And here we go. We'll take a look. There we go. We'll take a look here at these different asset classes. Interestingly enough, bonds and the dollar are both down, but keep in mind, it's not. I don't think it's as much the dollar right now as it is the euro. That's your safety trade. But long-term bonds have been down, getting this overbought cluster. We'll take a look at those charts here in a second. But gold is really taking off here. So safety from those perspectives. Look at the 10-year yield, getting an overbought cluster there. Commodity prices, whether it's crude oil or just commodities in general, which is mostly crude oil on this ETF. Look at Bitcoin dropping pretty sharply. And this is inflationary right here. These two combinations with the dollar dropping is inflation, right? That's what those two things, especially with gold rising. Bitcoin, remember, has been talked about being an inflation hedge, not really joining the other inflation trades as you'd expect it. So maybe not quite what people thought it would be. There's a global equity market, dark pink shading in a red line. Developed markets and emerging markets not nearly as bad as what we're seeing in the U.S. It's mainly a U.S. story here. Silver is actually jumping up along with gold, big time jump in silver there, and copper still kind of sideways, really not doing much of anything. I wanted to show you some of these charts. So here's the high-low index, the U.S. highs and lows, dropping below 1,000 for the first time. You can see it only drops below 1,000 on these major declines. So you look at these declines, and again, they're last part of 2018, 2015 and 16, the COVID low point. Obviously all the bear market lows there. 2011, those were all pretty significant declines in the markets. But look at our decline now. It doesn't nearly look as significant on the upsides, which, again, suggests that we might again be very, very early stages from this perspective. The skew is actually finally dropping down. It jumped up today back to 135%, which again goes to show that the pricing, the market's still concerned. Like when it gets, look at the at what it does when we are like at the lows, when we're kind of done with the declines. So this was the decline back in September, October of 2021, and we didn't drop very far. But go back to September, October of 2020, which is a very normal intermediate pullback, and we dropped all the way down below 120. Same thing with the COVID, we dropped way down there. Same thing with these intermediate declines in 2019, we were down well below 115. Late 2018, we got down below 115. You go out a little bit further to 2015 and 16, and we dropped down below 120 on the skew by the time it was all said and done after these declines. And again, going out to 2011, of course, we weren't as high at those points, but in 2011, we also got down below 120, if not below the 117.5 level, almost to 115 at those levels. So, needless to say, we are right here. We are way up here. We're still higher now than we were before the 2011 drop, right? Before at some of these peaks here. We're higher now than we were before the bear market peak on the skew. So the skew is still saying there's still a lot of concern with the VIX not being up to 100% yet or higher, with this not being down below 120 yet. It's still saying that the options market is suggesting that this is not anywhere close to being done. You take a look at the trend today. We were up above 115, but again, not significant peaks here. Like the average is still below 90%. So like the average for the trend, which means we've had very, very little declining volume during this decline relative to the number of advancers versus decliners. That was a pretty significant drop. That was a really, really low move. This typically peaks when we were at these lows. You look at, if I were to go out 10 years, and you can see, how the blue line gets really big when we have these drops here. It gets really big when we have these drops, and well above 100%, up to 115, 120%. When we get over here, when we got these drops, we got up to 150% during the 15 and 16 drop. And you can see here's the 2018, we got up to 120%. At the end of 2018, we got to 120% a couple of times. Right before 2018, we hit 80%, very similar to what we hit now. So we hit that also earlier in 2021 before the NASDAQ had its decline. So we hit 85% here, and now potentially making a run up. And of course, to get the average up, the 20-day average up to 120, 150, 120, we have to start getting individual days up, which means lots of really heavy selling there. If you take a look at how many stocks are below like their 50-day moving average, I don't know if this has been updated yet for today. No, it hasn't been updated yet for today. But you can see we are below the mean, but we are hardly like standard deviations lows, right? Again, let me go. This one only go out 5 years. But if you look at the COVID drop, we were 3 standard deviations at the low. At the 2018 drop, we were 3 standard deviations at the low. Even in early 2018, we were more than 2 standard deviations from the mean. We are just barely below the mean. Barely below the mean, right? If I do the same thing for the 200-day moving average, what percentage of stocks are below the 200? There's your 3 standard deviations below in 2000 with the COVID, almost 3 standard deviations at the 2018, at least 1 standard deviation for the early part of 2018. We are just below the mean right now, just barely below the mean, coming off of a really strong move that we had earlier this year. So again, you get the picture. Hopefully I'm painting a decent enough picture that we may just barely be beginning. And it's not a bad thing, right? It's not a bad thing to get a 15-20% number on this particular chart, on this zigzag chart here. If you were to go out to remember, this measures how big of the rallies and the declines of at least 10% or more on a week-to-week basis, on a close-to-close basis. So not high to low, but on a close-to-close basis. So if I take a look at SPX during this bull market, we've only had the 2010 drop of 16%. That followed up with a 33% rally. We had the 2011 move that we've talked about, 18%, followed up with a 90% rally. We had a 12% drop in 15 and 16. As bad as that was, it was only 12%. Followed that up with a 57% rally. We had a 17.5% drop in 2018. Again, as bad as that was, 17.5. Followed that up with a 40% rally. And then a 30% rally drop, which is pretty significant with the COVID, obviously pretty anomalous there. And we followed that up with a 100% rally. And now we're down 5. So we still don't even have a red tag yet. Now we do on the Russell. The Russell is down 15%, which is why we're hedged more against the Russell, because there was more potential for weakness in the Russell. It tends to have bigger drops anyway. It's had a lot more 10% drops. We had a 25% drop there in 15. We had a 25% drop in 16. We had a 25% drop in 11. So to get a 25% drop is not out of the realm of possibilities. Pretty darn likely. And so that's why we were hedged more against that one than some of the other indicators there. Let's take a look at the major markets. This will be an interesting chart to look at. We'll look at the 12 grid here. So here's the biggest economies and what their ETFs look like. You can see Japan dropping hard. Russia, dark pink shading and red line. Korea, dark pink shading and a red line. Obviously the U.S. Remember, Korea is a proxy for global economic growth. China, not so bad, right? And India, still holding up strong. Look at Brazil, breaking out. It had been so bearish, but breaking out now with the intermediate line up above 50. The Canada is holding up really well. Italy, UK. UK's got an intermediate line at 94. So, this is hardly a global breakdown. It's really mainly a U.S. equity breakdown. And that's why I wanted to show you here on this chart. If I go back over here, here is the international stocks relative to U.S. stocks. And look at this breakout move. The RSI getting well above 60, getting up into... getting up above that 70 level there for the first time in a while, right? If you look at the 5-year chart here, you can see getting above 70 for the first time since really back in 19 when we flirted with getting above the 200-day moving average, and again over there at the end of 18 when we were flirting with at that real significant decline. So here we are again, and we're still below that 200-day moving average. But our MACD is really strong. The PPO here is really strong. It's rising. It's coming from really low levels, again, suggesting we may just be getting started. The very strong CCI getting well above 150, even making a run up above 250 initially on the surge. Look at that positive. See, this positive indicator compared to all these other peaks, right, that we had, what would be in 2020, 2019, 2018, you come down here, and all these peaks on the positive, this is by far the biggest. We haven't had as big of a peak since way back here when we were bullish. So very, very strong peak on the DMI, positive DMI, almost up above 50. The negative still hasn't even dropped below 20 yet, and the ADX is still below 22, so it hasn't even started the trend. So again, there's a real significant opportunity for international equities, which have been underperforming for years, to really change the narrative here. If I were to go out to 20 years and then go to a weekly chart, you can kind of see here, this again, we only go back to 2011. You can see the significant underperformance in international equities relative to US. And then let me change this chart here to the weekly version. There we go. And you can see the PPO and the MACD rising there. You can see what the CCI is doing, and you can see what the global, the weekly ADX had been up to 30, and it's just now barely ending, right, on the weekly basis, much less starting a new bullish one. There's a very good chance that we will start a bullish one because we are well above the 17-week exponential moving average, now above the 30-week. And the MACD is, we are in bullish divergence mode and making a run up here to the upside. So again, another indication that we might be shifting away from these really overbought U.S. equities, where the Case-Shiller index is still, above 35, way up near 40, and all the other global Shiller indices. Like here's China, well less than half of what you saw there. In fact, I did tweet this. I retweeted this from Meb Faber. Here we go. I retweeted this from Meb Faber here. Here's the emerging market stats. You have, in terms of the share of global population, global public markets, global GDP, global market capitalization. It's actually very similar. It's a little bit less than the U.S. by itself. Global, when you're looking at free float, is obviously a much smaller percentage. How much allocation there is from U.S. investors, and then how cheap it is. It is well more than 50% cheaper when you look at China. Here, let me take Europe off for a second. When you look at China, when you look at Russia, when you look at Korea, when you look at India, India is actually very similar to the U.S. And it was China, and then Brazil. Look at all of them are way down there compared to developed markets, compared to Japan. They are way below the average compared to some of these other equities. So there's U.S., Japan would be right where Europe is. So there's Japan and Europe, developed markets. There's your emerging markets, and then Russia kind of doing its own thing. But you see how emerging markets not only have a wide gap of valuations from the U.S., which has not, previously there hadn't been such a wide gap. Now there's a huge gap, but there's a pretty significant gap between developed markets and emerging markets. So you can kind of get an idea that emerging markets have really juicy valuations, relatively speaking, to especially U.S., but even their developed counterparts. Okay, let's take one last look here, and then one more chart. We'll look at the sector rotation. So let's take a look how sectors have performed here today. Let's go to the just today's chart alone. There's our big moves to the downside: financials, discretionary, technology, real estate, industrial, everything. The only safe haven areas that held up and actually gained today were staples and utilities. It's really significant sell-off there. And if I were just to go back to like the last week, we go to the last 5 days, you can see your safety trades holding up, whereas everything's dropping 6% or more. It's our cyclical areas are all on declines. When you look at the 12 grid chart for these, check this out. They're all dark pink shading and red lines, except for financials, which are just breaking down. Industrials also just breaking down. Energy, which is way overbought. And even you can see real estate kind of acting like everything else. There's where your safety is, and then right now there's where your relative strength is in here. So we are moving in the direction of safety on a lot of these indicators. When you look at the relative rotation graph, here let's go to the sector rotation, sector ETFs. We'll go on the daily chart. Here's your daily chart. Energy's got the strongest momentum still. Financials has the second strongest momentum, in industrial. So there's your cyclical areas have had the strongest momentum. On the other direction, you have technology, healthcare and real estate have the worst momentum. They also have the worst relative strength right now. Financials and energy have the best relative strength, and staples. That's on a daily chart. If you look at a longer term view, there's staples, there's utilities moving up to the right really rapidly. Energy still holding up as well, but then you take a look at what's dropping. Look how fast XLY is dropping. XLC is down still, even though it's rising. It's still down in terms of momentum. Technology is dropping. Financials is down. So not a whole lot of long-term relative strength and momentum in these areas, and you can see it's really picking up really to a big degree in these safe haven areas there. All right, so for our trade idea of the day, I wanted to take a look at U.S. Steel, and you can see U.S. Steel is breaking down like everything else is. Pretty soon, the intermediate line's rolling over, pretty bearish short-term sentiment. Market sentiment line has been below 40 already, so it's been kind of on this really sideways action, very similar to the Russell 2000, right? Kind of like this big kind of long-term, rally, because it's actually coming off of, it was right before Halloween. Remember, Russell 2000 actually bounced in late September, and it was the S&P that in NASDAQ that was late October of 2020. So from that rally, going all the way up to the peak here for U.S. Steel is about, and again it was a little bit later, it was in May of 2021 instead of March, so a little bit higher peak. But we've been kind of sideways ever since too. That time frame, you can see where we're at there. Breaking back down below the 23% line. The market sentiment line had not really been below 40 until now, because we haven't been able to get really bullish on these last intermediate rallies. This one got up above 80 before short-term sentiment declined, and we had a new leg lower. This one did not get above 80, which makes it, in my opinion, makes it more bearish than what we've seen previously. We're breaking down pretty hard there. If you look at this chart. The weekly crossover, we've been converging. It looks very similar to the Russell 2000. You can see this week, still got 2 more days left, right? But this week we're below both the 50 and the 200, the 10 and the 40 week exponential moving averages. When you look at the 3 green arrow chart, and they'll look like they're 2-line versions. The MACD is just breaking down below. We're just breaking well below the 7. We broke below the 17 yesterday. We were definitely holding that today, but breaking below the point of control in the 1-year chart. So the MACD and stochastics are diverging to the downside. It's a pretty decent amount of volume today. If you take a look at some of these oscillators, other oscillators, the DMI is breaking out above 25 on the negative indicator. The positive still has some room to go to the downside. If you look at the RSI and the CCI, we are flirting with 40. I mean, we were just at 60 just a couple days ago, and boom, back down to 40, well below minus 100 there. If you look at the trend strength indicators, we were bullish. Now we're done being bullish, right? And we were well below the cloud on that. If you take a look at the Bollinger Bands, we're pushing down. We were well up in the upper quartile just a few days ago. Now we're easily in the lower quartile, and like I said, below the point of control. And you can see getting below that 38% retracement level, there's just not a lot of volume. We moved up so far so fast that once you break that level, there's not a lot of volume down here to these other Fibonacci retracement support levels. So opportunity to be relatively bearish on this particular stock. And so what I did was I did a long put trade. So let's go to X. We did on April. We went out 85 days. And we bought the at the money put, and we put a 50% stop order on it. That's my sell order. You can see that's my stop order at $1. We got in at 260 roughly, I think, if I remember correctly. We got in 260. So my stop order is at 130 with position size for about a $500 loss roughly. And then you can see now, if I were to go to here and then just go, let's not do beta weighted. There's the trade. So we're actually up a little bit since we got in, only about $20, but we're up since we got in. And then if we do 1 standard deviation by April expiration, actually right there because it's a Good Friday it looks like, then if we get down to right now 1 standard deviation is down to 13 let's go to the closing, down to 15 on a closing basis. That's our target, was 15. So if we touch that here, and there's a 29%, about roughly 30% chance we will, then we can get a roughly $2,200 reward for the $500 of risk where my stop order's at on this. So pretty decent reward to risk ratio if it ends up playing out. Again, 15, when you look at it on this chart, it kind of gives you an idea of where 15's at. It's right down at that 62% retracement. So if we drop and we break the support, because everything else would be right, and we hit support, we hit that Fibonacci support at 15, then we'll take our reward at that point. If we rally back up, but if we get back above these moving averages before we hit our stop and we get back above that 23% line, then we'll just take whatever small loss we have. Obviously, if we haven't been stopped out yet, we're less than $500, but we'll take whatever few $100 loss we have and move out of that trade on that case. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's threads. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, as well as our website at marketscholars.com. Click that thumbs up icon. Like us on Twitter and Facebook too. Comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all tomorrow.